This is a presentation of the weekly real estate market here in Silicon Valley for the week ending June 27th, Friday at 11:59 p.m., presented on Saturday morning, June 28th. Here are the 15 key chapters that we're going over. I do have a PowerPoint handout that's up. The instructions are in chapter 12. The timestamps are in the YouTube description below. Let's get right into the data slides. Here's the summary slide. The big takeaway from here is notice how the green, which are comparing to the previous 10-year median, is blue in color. That means that we're basically having a market that is more favorable to the buyer this current year than we typically do based on the last 10 years. Also want to point out something that's a little interesting. If you notice, the median price for Silicon Valley over here is $1.7 million. If you also come back over to the left, jumping around on you, the expensive areas, Cupertino, Sunnyvale, and Los Altos, Palo Alto, which have a median sale price of almost $3 million and $4 million, are actually selling a much higher percentage at over 100, where most of Silicon Valley is somewhere around 75%. If you look at the appreciation, Santa Clara County's had 119% appreciation since 2015, which is way above San Mateo and Alameda County. It's not that we're doing that much better on price appreciation, but it's the fact that the median price for Santa Clara County is pulled up because you're selling a significantly larger percentage of expensive homes. When you're selling more expensive homes, that pulls up the median. Or if you want to look at the flip side, we're selling fewer of the less expensive homes, which pulls up the median because there's fewer low-priced homes weighting it down. So I just want to throw that out. The yellow section here is just the market conditions in general. So, and even though that Silicon Valley is favoring a buyer more than it typically does for this time of the year based on the last 10, it's still a pretty aggressive marketplace. And, whether you look at days unsold inventory, or if you look at marketing time, marketing time is a month for all of Silicon Valley, 27 days for Santa Clara County. So that's still fairly fast. The price adjustments are about 1 in 5 sellers in Santa Clara County and in Silicon Valley are adjusting their price. So that means 4 out of 5 sellers aren't adjusting their price. And the orange tabs, which are the reddest, are lagging indicators. They're overbidding. And in order to get what the sell price is, you have to wait for escrows to close. And then finally, you have the appreciation and the sold price. And instead of just the median sold price in the middle, we have the cheapest 10 percentile on the left and the most expensive 90 percentile on the right. Here now is a slide that shows just sales activity for 1 week. And normally I use everything a 5-week period to get it more stable, but this is to show just what's happening in the marketplace right today in gross terms. And basically what you can see is we've had a lack of sales, and that tells us the story for the last year and a half. You should be up on the gray line, which is the median number of sales based on the past 10 years. The red line is the most sales you'd expect, and the blue is the least you'd expect. So clearly we're having an issue with the volume of transactions. Here now is a summary slide of the 3 key indicators. First, we'll start off with inventory. Inventory is higher than it typically is, but not as high as it has been. It's been as high as 3,330 at this time of the year, and now you're at 3,200. So you're 150 listings or 5% below the most number of listings you'd expect, but there's still more inventory than you typically would expect for this time of the year. Here is actually a quarter ago, 13 weeks ago, and I showed the trends based on the past 10 years going out for the next 13 weeks. But of course, the purple line stops with the current week in the middle, and this is the current week. Then moving down to offers accepted. You can see offers accepted were between the median, the gray line, and the least you'd expect. And now in the last couple of weeks, they've been right on the blue line. And this week, they actually dipped below. The blue line is at 2147. And this time we're at 2111. And this 2111, because escrows fail, will actually more likely go down. And the 2147 is going back 10 years. So a 10-year-old transaction either closed and was counted, or it fell through and wasn't counted. So the 2147 number isn't going to change until we add another year next year. But the 2111 is very likely to go down, which makes the lack of offers accepted even more significant. Number of transactions, these are closings based on the last 5 weeks, and it is very similar to the offers, but it is slightly above their least number you'd expect. In other words, the least number you'd expect is 2105, and we're actually closing 2178. So you're closing 73 more transactions than you'd expect, which is somewhere around 3.5%. Then you look at the seller buyer demand balance, and that's the supply demand balance. And I measure that in days unsold inventory. You hear a lot of people talk about months of unsold inventory or months of inventory. That just gives you an idea of how fast Silicon Valley is moving. Most parts of the country consider 3 to 7 months to be normal. We're sitting here at 40 days and saying that that's slow. And that's where we were a quarter ago. Now we're all the way up at 53. We're not even to 2 months and we're saying it's slow. And you can see it's slow. Look how much above the blue line it is. The slowest you'd expect is right here at 47 days. So you're a whole week longer than the longest you'd expect it to take. Typically, you're at 5 weeks, and the quickest market we have in Silicon Valley is at 4 weeks. So you're almost double the quickest market time. And obviously, when you're doubling marketing time, that's a slower marketplace. Then the metric I like to measure, this is the turnover rate, basically, how quickly is the market turning. And this is actually marketing time. What I do for marketing time is I don't look at the average or the median, as most people that report on the real estate market do. I look at the 75th percentile. How long is it taking 3 out of 4 sellers to sell? And a quarter ago, that number was 16 days. Now it's 30 days. So it's doubled. And you can see that we went from very close to the red line. And if we went back a couple more weeks, we'd actually be below the red line, to crossing over the gray line, to crossing over the blue line. And we're actually quite a bit longer now than the blue line by 5 days. That's getting close to a week. The longest you'd expect is 25 days. And as I said, we're at 30, and we're 176% or 76% longer than the typical of 17 days. You can see it's hard to get shorter, because the shortest you'd expect this time of the year is only 15 days, which is very close to the 17 that you'd typically expect. Moving on to price reductions. This is what the sellers are doing to get buyers to come in and make an offer. It's not what they're doing when the offer is presented, it's what they do before the offer is presented. And again, you can see you were between the gray and the blue here just 13 weeks ago, and now you're below the blue. But the blue is actually catching up to the purple line, because see how in the last couple of weeks the blue line really has fallen off. So now you're getting to the time of the year where sellers are typically doing price reductions. We just got there earlier this year. How much are you talking about? On average, not very much, only 1.33% price reduction. And the reason that number is so small is a large number of sellers do no price adjustments whatsoever. But typically it's only 0.7%. So you're double what you typically are as far as the magnitude of price reductions. And then the last one is not sort of a leading indicator at all. It's a lagging indicator, and that's overbidding. And the reason it's a lagging indicator, again, is you need the escrow sale price. And you can see that right now you're coming down and you're sort of having the least overbidding. And this is not a percentage basis, it's raw count. Normally a quarter ago, you would have expected 6.5% overbidding, and you were getting 8.6. So you were higher, you were 2 percentage points overbidding higher. So instead of overbidding 6.5% on the gray line, buyers were actually overbidding 8.6% on closings from 13 weeks ago. Now they're only overbidding 7.4%, so just under 5%. And normally they're bidding almost 7.5% over the seller's ask price. So you've lost 2.5 percentage points of overbidding. So competitively, it's been as high as 11.6% at this time of the year and as low as 4%. So we're getting close to the least amount of overbidding you'd expect. Now looking, instead of just looking at the past quarter, this is looking at long term. This is going back full 10 years. This is going back to January 1st of 2015 on the left-hand side. First indicator we'll look at is inventory. This is the purple line, and you can see we've come down. We were up here at 135, 138% of normal. We're now down around 118% of normal. But still, when you come back, that's more inventory than we typically have. There was a period of time here in 2018 and early 2019 when you had more inventory. And yeah, you were sort of on, right in the same ballpark back here. But this is relatively large, high inventory. And you can see that in January, we actually had a shortage of inventory, not as dramatic, but you were sort of on some of the lowest inventory. So you went from some of the lowest inventory you'd have to some of the most inventory you'd have, and you did that in 2 months. And you really did the increase in 1 quarter. And in this last quarter, it was sort of at a plateau for half the quarter. And then the second half of second quarter, it has been dropping. So we've been improving. We've been getting less inventory than we would expect. I look at everything compared to where you expect it to be. And that's because the cycles are so severe. Normally inventory is going up. So even though this is going down, you have more inventory now than you did back up here, but it's more in line with what you'd expect it to be. Moving on to offers accepted, that's the orange line down here on the bottom. You can see our offers accepted have been below where we expect it to be. And right now we're about 76% of the level of inventory you'd expect. But it's been that way all of 2023, all of 2024, and now all of 2025. We had a bubble up here after the pandemic shelter in place was released where we could show houses. And that was because everybody's housing needs changed. Now those people purchased or refinanced and have a 3% loan in a marketplace of somewhere around 6.5%. Buyers and sellers aren't moving. So there's just less inventory. And with less inventory, there's less offers. Offers aren't limited based on the number of active listings, because clearly then we'd have more offers because they have more inventory. But it's the fact that the buyers for a lot, your trade-up buyers, think of your trade-up buyers, they're locked into their 3% mortgage. They're not going to go and sell for a 6.5% mortgage and an increase in property tax and everything else. So there's just a lot of buyers that are staying on the sidelines, which is why you have a limited number of offers and you have large number of active inventory. And then the balance of the two, days of unsold inventory, is the key up here. And that's the turnover rate. And you can see that's the longest turnover rate we've ever had. Yes, there was a short little period of time back here, right at the end of 2018 when it was higher, but that's basically Thanksgiving. And here you've been almost all quarter, you've been at record high numbers. So the speed of the marketplace, the turnover rate of the marketplace is at record slow speed for this time of the year. Now we're going to look at each component in detail. We're looking at inventory going all the way back to January 1st, 2015, and up through January 1st of 2024. It's on a condensed scale. And then for 2024 and 2025, the x-axis, the date axis, the horizontal axis is taking up twice as much real estate. And that's so that you can see these little spikes a little bit better. So you basically right here at record level of inventory, you've been at record level of inventory all of second quarter. Beginning of first quarter, you were at record low inventory. So first quarter went from record low to expected level of inventory, and then from expected level of inventory to record high level of inventory. And we've been basically at that record high level. And when I'm throwing out the record high, it's really not a record high. It's the most you'd expect high. Here's on a percentage basis. So you can see the percentage of inventory is actually turned around and improved. I think we're at 118%, but that's still a relatively high number for Silicon Valley. Here's the offers accepted. You can see that in second quarter, we were spending some time above the blue line, but now we're right on the blue line. Basically, the last 4 or 5 weeks, we've been tracing that blue line and having offers accepted the least number that you'd expect. Here's on a percentage basis, and you can see that the offers were actually climbing on a percentage basis. It was down at 75%, got up to 80%, and now it's back down to 76%, rough numbers. Here's your days of unsold inventory compared to the 10-year median. You can see that you expect it to be down here at like 35 days. You're up here at 56 days or 53 days maybe. You know, that's a pretty high number. You can look back on the purple line. There's little times when it was higher than that or roughly the same magnitude. But notice that those are, except for the pandemic, which is here, this one here back in 2019, this one here in 2023, and this one in 2025 are right after the New Year's. So to have one this high now is very unusual. And again, this is showing the huge daily cycle or weekly cycle that we have. You can see the upside down sine wave here, and then you got another U here. It just goes up and down. It's almost like someone's heartbeat in a hospital. Here now is compared to typical. So you can see that you're at record high numbers. Yes, it was higher during shelter in place. And it was only a couple of weeks ago that this graph cut off at 170%, and I expanded to 200. And right after I did that, I turned around and went the other direction. But you're still at 150% longer turnover rate than you'd expect. Here's marketing times. It came up fairly dramatically. Look at this. You went from record low numbers, you know, and this is where I was talking about this time shift. Notice how the gray line, the typical line, which is how you expect the market to behave, shifted much earlier, almost about 7 weeks earlier, half a quarter earlier. And then it just plummeted down like it normally does and turned around. And instead of having a little bit of a plateau, it immediately started increasing. And so now it's increased. The increase is just happening earlier than it typically does. And it's really interesting. This week here has been totally flat. That's just a nuance that we have July the 4th, almost one of the earliest dates that you can have it on, not the earliest dates, but it's on a Thursday. So the impact comes back further in the calendar year because today's only June 28th and sellers don't like to go on the market on holiday weekends. This would be considered a holiday weekend. Those people that are traveling somewhere will take off all of next week. So they're busy getting ready or they're already on the road. That means fewer buyers out there to look at the new inventory. Therefore, sellers can either accelerate their plans or hold off their plans to avoid the holiday. Here's marketing time compared to typical. You can see you're up here at about 178% of the typical days on market. And this is for 3 out of 4 sellers to sell. So only 25% of the sellers are taking longer than this amount of time. But you can see that you're, not quite double, but you're clearly longer. And look how rapidly that has increased. Halfway through first quarter, and now we're at the end. So 45 days ago, you were down here and only at 30% of the typical speed of the marketplace. So you're selling it in 1/3 the time. Now you're selling it in almost double the time. It's taking almost twice as long. So that's almost a factor of, it is a factor of 6, because 6 times 30 is 180, and that's darn close. So you're now 6 times slower than you were just 45 days ago. Noteworthy back here in 2022, our last time the market really slowed down, you were at the same level of 30, but you only got up here to 140 before you basically leveled off. So the slowdown this time is actually more pronounced than it was in 2022, but we're not having the associated price decreases that we had in 2022, which is interesting. Here now is the number I like, which is looking at the sellers that are taking the largest 10% reduction. You ignore the top part of the marketplace because those could be people that are fluctuating all over the place. And typically, less than 20% of the sellers are doing a price reduction. So this is sort of the median of the sellers that normally do a price reduction. That's sort of how I back myself into this number, because it is not a common metric. But you can see that, we started off the year with more price reductions than typical. We were raced up real rapidly and got up to the least amount of price reductions you'd expect. And then we turned around and we've come down and we're now taking more price reductions again than you typically would expect to have happen. So we've gone through a fairly significant time shift in marketplace just since the first of the year in many of the metrics. Here's the price reduction on compared to normal. So just earlier, 45 days ago, we were down here at something like 85% of the price reductions you'd expect. So 15% less price reductions than you typically would expect. And now you're up here, even after the improvement, at something like 34% more price reductions than you expect. We got all the way up here to 60% more. Now back in 2022, we got up to a slightly higher number, but roughly the same magnitude. Here's the seller's ask price reductions on average. So now they're taking a 1.35% price reduction. So you can see that we got all the way up here where we were only taking 0.5% price reduction, then it fell off pretty early. It was basically following the gray line for the most part until we got 2/3 of the way through first quarter. And then it just fell right off. And now the blue line's falling off more steeply, so catching up to the purple line. But it's the gray line where you expect the market to be. So it's this vertical separation back up to the gray line that you should be looking at. And that's what this percentage graph shows you. You can see right now you're at not record high territory, but reasonably at the higher end of expectation. We were at record high, basically, or close to record highs, just at the beginning of this quarter. So less than 13 weeks ago. So we've had quite of an improvement. But look at the drop off here. But notice how in 2022, we had a drop off, we had a little comeback, and there was a second drop off in 2022. And now you have this one data point. In my opinion, it takes 3 data points to show a trend. And, you could argue you have 2, you got the peak and then you got 1, but this one is probably more associated with the holiday than anything else. So I wouldn't count it. So in 2 more weeks, we might have an indication on whether we're going to see another downturn like we did in 2022. Every market shift is different than any other one. It's sort of interesting. Now you're looking at the frequency of those price reductions. How common are they? And you can see 45 days ago, you were down here and only 7% of the sellers were doing a price reduction. Now you're triple that at 21% of the sellers are doing a price reduction. So that's 1 in 5 sellers are doing a price reduction. So not a huge number of price reductions, but still way more common than you expect. You'd expect it to be down here somewhere around 13% of the sellers doing price reductions. That would be about 1 in 6 sellers. Here's the frequency again. So you're 60% more frequent than normal. And again, the only times you were really up there is in the 2022 slowdown and the slowdown that we had right in 2019. Here's the magnitude of overbidding. Right now, you're coming in at just under 2% overbidding. Typically, at this time of year, you'd expect it to be up here around 4.7%. So you're missing something like 2.8% lower overbidding than you typically do for this time of the year. And in a hot marketplace, you're up here somewhere around 9%. So you're 7% lower than if it was a hot marketplace. So here's your typical would be the gray line. Above average, above typical is in the pink. We were just there at the middle of first quarter. We're now significantly below at this below typical in the blue section. And you can see that these are sort of the least amount of overbidding that Silicon Valley would expect. And again, that's 2.5% off of this, what was it, 4.6% you'd expect. Here's the frequency of overbidding. So how common is overbidding? So even though maybe I've been a little negative on the marketplace, still 6 out of 10, more than 6 out of 10 sellers, 3 out of 5 sellers are getting more than their asking price. Now, part of that is, the pricing mechanism that a lot of listing agents are using here in Silicon Valley. And a lot of that is the marketplace that is aggressive are the new listings. And there's a huge fear of buyers of missing out on an opportunity. And so if there's other offers, that's when you get the overbidding. It doesn't matter what the price is. If 3 buyers want the same property, you can get numbers that are over the market value. Here's now the frequency compared to typical. So we're at 80% of the frequency that you'd expect. So less frequent overbidding, so less frequent and less higher magnitude. Here now is just a quick pricing model. You could assume an 11.4% appreciation, and this is on log paper, and you'd be right about where you are. Or another one would be about 12.5% and then about 3.3%. Or you could actually even increase the 12.5% up a little bit and call the prices fairly flat for the last 3 years. And I think that's probably a little bit more accurate. It's sort of hard to do when you have the huge annual cycle on top of everything. 2023 was a little bit lower than 2022. But 2024 and 2022 were very similar, and 2025 is very similar to 2024 and 2022. So that's why, yes, there was a dip in the price, but if you're just drawing straight lines, you could argue there's a straight line through something like this, which would mean you just have to extend the 12.5% for a little bit longer at a little steeper rate. Maybe I'll make that adjustment. Now we're looking at distributions. We have 3 different distributions. The first one is on marketing time. The purple line is the current week. The dotted line is where we were a week ago. The hottest marketplace we ever had was down here in the red. The coolest were up here on the blue. So clearly the purple is above the dotted. So we're a lot slower, a lot longer marketing time. And this is a good example. This is the median down here. So there's almost been no change, maybe a change of 1 day in the median days on marketplace. But if you come up here to the 75th percentile, now you're having a significant change. And if you jump up here to the 90th percentile, the change is even bigger. Statistics is about trying to get a handle, a measure of what the market's doing without having to look at all the details. So now we're going to step through. We're going to start off on the dotted line a year ago, step a week at a time initially. You can see it was cooling off. So this is the time of the year where it cools off. And then we're going to start jumping 2 weeks at a time right now. And you can see that we're basically just bouncing now during the summer. There's really not much of a change. And now you're at Thanksgiving. So look at the slowdown that you have. And right there is the slowest marketplace on December 20th. Now notice that my next date is January 3rd. So it could be that December 27th is actually the slowest, but I don't have that this week. That will be back next week. Then you're already starting to improve. Notice how steep the line is getting over here. And that's why I say this is the worst for the year, which was November, Valentine's, or the hottest for the year, Valentine's Day, because now notice the next slide is much flatter, and that happens when the market's already slowing down. So even though they're roughly the same magnitude, the fact that the top end is flattened out indicates the market's already slowing down. So sometime between February 14th and March 1st of this year, the market started slowing down. So the peak of the market was right around Valentine's Day. And now you're coming up to getting pretty close to current day. Right there is last week, then the green. And the reason I stopped it here is notice how the purple's right under on top of it. So there's basically been no change at all. Now up at the upper end, the purple's a little bit on top. So you might say there's been a slight change slowing since the green. And there is the purple so that you can see it, but now you can't see the green from last week. Now moving on to the same concept with the largest price reductions. Here, we had a week, which was basically Valentine's Day of 2022, where no sellers, or at least less than 2.5% of the sellers were taking a price reduction. And, right now you have more than 17.5%. I think the number was somewhere around 21% of the sellers were doing a price reduction. But notice how the bulk of the data is up here at 100% by the 17th percentile. So stepping through initially 1 week at a time, you can see that the market is cooling down, but not very much. It's basically bouncing around, not doing much changes. Now we're in the 2-week jump cycle, a little bit of improvement and then slowing down. Now we're slowing down for the end of the year. That's the coolest we had. Again, it's December 20th. I don't have December 27th data. There you have improved dramatically. And that's going to be the peak of the marketplace. Notice that's Valentine's Day of 2025. And then you're going to have another one March 1st, which is about the same level. And then you're going to start cooling off. And now you're approaching current stuff because the lines are solid. And next week, there you are. So you're still slowed down a little bit from last week, but in general, we're on the cooling trend, and we're taking much larger price reductions this year than we did last year. And the last distribution is buyer overbid. This is buyer competitiveness. How many buyers are concerned about missing out on their dream home? And you can see the purple lines down here are much cooler than we were a year ago. We were almost at the highest on the graph. Now there's going to be one up here that's higher, but you're close to the highest. And this year you're close to one of the coolest. And that doesn't tell you the market's changed. I don't know what does. But there you can see you're already cooling down. So that means we expect the purple line to cool down from where it currently is. And now you're getting into a place where it just bounces at 2-week increments. And because this is price overbidding, you have the delay. So it's going to happen more at Thanksgiving instead of Halloween. Now you're getting to the bottom of the marketplace right there on January 31st. But if you have to wait to escrow's close, that again puts you right around that December 27th time frame. And then the market rapidly improves. Right up here is the peak of the market price. Right there is where it looks like I did it on March 29th. 35 days earlier than that, 5 weeks earlier than that, was just basically Valentine's Day, again, sort of indicating where the peak of the marketplace was. And now you're sort of cooling off. And your solid line, so you know you're getting close. That's about 2 weeks ago. That's the last week. And we're still a little bit cooler this week. So more price, less overbidding this week than just last week. Now we're comparing the 3 counties, San Mateo County in the orange, Santa Clara County in the blue, and Alameda County in the gray. Alameda County is back up to its historical inventory levels. Santa Clara County is a little bit low, maybe 10%, 15% low. And then San Mateo County, noteworthy, is at an all-time record high. And it is clearly an all-time record high because it's been above 600 and never before has it even reached 600. About 575 was the most you got in some of the years back here. So San Mateo County has more inventory than it ever had. Here's your offers accepted. San Mateo County is accepting less offers. So it's going to have a slower turnover rate than it typically does because it had more inventory, less offers, therefore a slower turnover rate. Alameda County is up here accepting less offers than Santa Clara County is in the blue. So Alameda in the gray has less offers accepted, had more inventory. So most likely the only winner is Santa Clara County is going to have the fastest turnover rate because it had the most shortage of inventory and it's got a shortage of offers, but it's outperforming Alameda. And sure enough, here we are. Santa Clara County is at the bottom with the quickest turnover rate. something like 45 days. San Mateo County is next at about 52. And Alameda County has the slowest turnover rate at about 63 days to sell to your existing marketplace. The marketing time is in the same order, but much lower numbers. Alameda County is at about 34 days to sell for 3 out of 4 sellers. San Mateo County is about 31 days, and Santa Clara County is about 27 days for 3 out of 4 sellers to successfully sell, get the offer in on the property. Here's the magnitude of price reductions. So Alameda County is taking the largest price reductions, which is a little weird to have the largest price reductions and the longest marketing time sort of go hand in hand, actually. And then San Mateo County and Santa Clara County are exactly tied at something like 1.25%, just over 1.25% price reductions. Now, the frequency of price reductions most frequent in Alameda County, and again, Santa Clara County and San Mateo County are very close together at about 18% of the sellers are doing price reductions. This is what's unusual. Alameda County, despite having the most price reductions, the most frequent price reductions, and the longest marketing time, actually has the most overbidding at just over 6%. Santa Clara County and San Mateo County are very close together at 4% overbidding. And I think what's happening in Alameda County is sellers aren't able to sell, lower their price below where the market is. Then buyers are coming in, and the properties that are selling are those that are now have a lowered sale price, offer price, but they're overbidding that because the seller took off too much. Here's the frequency, very close together. The least frequent overbidding is in Santa Clara County at just under 60%. The most overbidding is San Mateo County at 63%. Here's the long-term appreciation. We talked about Santa Clara's up here at 120% appreciation, but that's the shift in the marketplace. Right now in Santa Clara County, it's the expensive areas. It's your Cupertino, Sunnyvale, your Los Altos, and Palo Alto that are doing more than 100% of the transactions. That brings up your median sold price. It doesn't necessarily mean values are up. Here you can see San Mateo County is just below. This is the same information, but on regular paper. And actually, that was on log. This is on log paper, and you can see San Mateo County is below Santa Clara County. And when I flip on to regular paper, you can see the magnitude. Santa Clara County is at 2.1 million, and San Mateo County is at 2,075,000. Alameda County is all the way down here at about 1,325, $1,325,000. Here's the estimated payments, assuming that you're doing a jumbo, large, high balance conforming loan at the Freddie Mac limits, which is actually an overstatement of the interest rate because jumbo money is cheaper. And a lot of people in Silicon Valley have retirement accounts that they can get a relationship bank pricing with major lenders. Now we're moving on to micro market areas. Here you're looking at active inventory compared to the 10-year median. You can see in most of the areas it's blue. The area where it's more active, less inventory, is your expensive areas in Santa Clara County. Here's the offers accepted. You can see that offers accepted in Cupertino, Sunnyvale is at 13% above normal, 10% above normal. It's below normal everywhere else. This is what's bringing up the sale price in Santa Clara County. Here is the days unsold inventory. So where's the market the quickest? In Cupertino, it's turning over 50%, half the time than it normally does. Remember, we were talking about it taking 1.5 times longer and 3 times longer in some areas. And here in Cupertino and Sunnyvale, it's taking half as what it normally does. Here now is days on market, the 75th percentile. So your marketing time, this is getting pretty blue. And this is compared to the 10-year median. So it's taking sellers longer to sell than it normally does. And here's price reductions. Sellers are taking more price reductions than they normally do, except for in Saratoga, Los Gatos, and Los Altos and Palo Alto, where they're taking less price reductions than they normally do. Here is the frequency, and it's either white in color or blue. So, you're taking a little bit more frequent price reductions, but it's also saying the magnitude of those price reductions are greater than they typically are. Now we're shifting over into saying what it is. We were comparing it to the 10-year median. Now, what is it? Well, you're selling out your Santa Clara County in 45 days. That's only a month and a half. You're selling out Silicon Valley in under 2 months at 53 days. So you're still selling quickly. You're just not selling as quickly as you normally do. So this is just the raw numbers. Where is it? What do buyers sense? So buyers are going to still sense that it's a fast-paced marketplace out there, but it's slower or fast paced than it normally is. Here's your marketing time for 3 out of 4 sellers. You can see it's pretty much white. There's some blue, 1 blue, and 3 pinks, but it's fairly balanced. So marketing time is about reasonable when you look at a normal. Reasonable is between 3 and 6 weeks, 21 and 42 days. Ask price reductions. Normal would be a 0.25% to 1% price reduction. You can see you're either normal or a little bit above that 1%, but no solid blues. Here's your frequency of price reductions all over the place, so well distributed, fairly normal. You have some areas where it's less common, you have some areas where it's more common, and some areas where it's just about what you'd expect. And that's based on these sort of artificial numbers up here, where the 10-year is compared to what the performance has been locally. Here's the buyer overbidding. We're looking at mostly red, so we're still having a fair amount of overbidding, even though it's less than it normally is. This is the frequency of overbidding, so more common than it normally is. San Mateo County coast is a little bit blue. Everybody else is pink or white. Here's your long-term appreciation, and you can start seeing that Santa Clara County's got the 118% appreciation, but no micro market area has anything over 100%. And that's because the market mix that I was talking about has shifted, and we're selling more expensive area homes. San Mateo County is pretty blue overall. Now, here are the prices. Not only do I follow the median number, which is the middle number for Silicon Valley in each of the micro market areas, but to the left is the cheapest 10 percentile you'd expect in that area, and to the right is the most 90 percentile you'd expect. So you get a price range. So instead of just knowing the middle number, you know the outside extremes on both sides of that number to better get an idea what your chances of buying a house in a particular neighborhood is. And these are for single family homes. Here's a summary of all the micro market areas. We started off with that, so I won't go into detail with it here. Here is looking at the number of transactions, offers accepted. You can see we've had 4 weeks now of the second lowest number of offers accepted. The worst year was 2023, but more significantly than the second worst out of the last 10 years, it's the second worst out of the last 25 years. And in some of those years, we're pretty close. We're within 5%. This week is probably going to be even closer, because this 2111 will decline as time goes on, and the 1988 is fixed at this point. Here's the raw numbers for Silicon Valley, Santa Clara County, San Mateo, or Alameda County. You can look at whatever metric you're most interested in. It is a little surprising that the number of new listings is up going into a holiday weekend, but the active inventory, which is a more accurate measure of what you'd expect to go down, has gone down in all the counties. The overall sales has gone down by a greater number, which has actually increased, which is a slowing down of the turnover rate of the marketplace. So that is interesting. But you have each one of the metric markets for each one of the things, and you can see that Santa Clara County has done the best on appreciation since 2015, up here at 219 or 119%, as well as down here at 53% since 2020. But as I've talked about earlier, that's because the market mix of the more expensive homes is becoming a bigger percentage of the market share. We have been talking about the Silicon Valley. We will be talking about the Greater Bay Area, 13 counties, 5 regions next. I'm Richard Callahan, real estate broker with Creekside Realty. My contact information is here. I represent buyers or sellers in single agency transactions anywhere in the Silicon Valley area. Please consider subscribing and liking the videos. The blue YouTube link up here is for the channel, which has the archive of all my presentations since the pandemic. The green URL gets you the same location, just less typing. To listen to the live presentation Saturday morning at 9 a.m., you type on the green root URL in the year 2025 and the passcode's there if it asks for it. If you don't want to use a linked URL, send me an email and I'll send you the Zoom meeting link as well. I don't mind it, it's longer. The handout is up. I got it up fairly early today. You type in the green root URL, the letter H, 2025, and then the month, which would be 06, and the date, which would be 28, because this is being presented on Saturday the 28th. And if you know a specific episode you want, you can get there directly without going to the channel by typing in the green root URL plus the year, month, and date that you're interested in. Let's move on to the Greater Bay Area. Here are the 5 regions. We have been talking about Silicon Valley already. We add in the cities to the mix, North Bay, the Central Valley, and the Central Coast. So now you have 5 regions, 13 counties. Here's the inventory for all the regions. You can see inventory has been going up overall. It's been flat in Silicon Valley, and it's also been flat and actually went down in both Silicon Valley and the cities this last week, but that's most likely due to the holiday. Here's the number of offers accepted, going up in the North Bay and Central Valley, coming down fairly significantly in Silicon Valley, coming down in the cities, still going up in the coast. So you clearly see that the cities and the Silicon Valley tend to act more similarly, at least so far, than the other three regions. Here's the turnover rate measured by days unsold inventory. It's basically climbing in all the areas except for the North Bay, which is actually been improving. Climbing the days unsold inventory is a slowing in the marketplace. You can see there's been a turnaround in the cities, but that's probably associated with the holidays. Here now is marketing time is increasing in all 5 regions. None of them have turned around. It's been flat this last 1 week in Silicon Valley, but basically you climb had a significant increase in the last couple of weeks in the cities area. Here's the seller's ask price reductions. All these are going down, which means an increasing amount of seller price reductions to get the offer in. The highest one is Central Coast. The lowest is the Silicon Valley, then the cities, then the Central Valley, then the North Bay, and finally, as I said already, the coast has the most price reductions. This is the frequency of price reductions. So Central Valley actually has the most common price reductions, followed by North Bay. So the order is not the same at all, which would tend to indicate, since Central Coast has the largest average price reductions and not the most price reductions, the price reductions on the coast have to be a larger percentage. Look at the increase in the cities. It's gone from something very reasonable, around 11.5% of the sellers doing a price reduction, all the way to 29% of the sellers are doing the price reduction. And that's just been in a matter of a couple of weeks. Silicon Valley has just been climbing at a sort of steady pace for a fairly longer period of time. Here's your magnitude of overbidding. So this is what the buyers are doing. You can see it's coming down fairly significantly in Silicon Valley. It's coming down fairly significantly in the cities. It's coming down in the other 3 areas, but not as much, but they also don't have as much to climb. Both the Central Valley and the Central Coast are now offering below the seller's ask price because you're below 100%. In the case of the Central Coast, it's about a 1% reduction. And in the Central Valley, it's a little bit more than half of 1% price reduction. Here's the frequency of overbidding. Where's overbidding most common? It's actually most common in the cities, followed by Silicon Valley, and they're fairly close together. They're both in the 60s. Then you jump all the way down to 41% for North Bay, Central Valley at about 35%, and the least amount of overbidding is the Central Coast at about 29%. Here's the long-term appreciation. Silicon Valley's got the highest appreciation, but we've talked about the market mix, followed by the Central Valley, and I believe that has a lot to do with all the building that's been going out in areas like Mountain House, which are more expensive areas than a lot of the Central Valley. And now they're being hit with the resale marketplace. And so you're having more high end, just like in Silicon Valley. Then you have the Central Coast, which moves up and down a lot more depending on what is actually selling. North Bay, and the area that's doing the least well is the cities at only 50% appreciation. You can see the cities got really hit coming out of the pandemic and just has not performed like the other 4 areas. Here's the sold price. The most expensive area is the cities right now, followed by the Silicon Valley, and then you have Central Coast, North Bay, and the most affordable is the Central Valley. And you can see how flat the prices have been in the Central Valley and even in the North Bay. So when you look at the Central Coast, it's gotten a lot more fluctuation, but you could argue fairly easily that that's been flat in price. And the same goes for both the Silicon Valley and the cities. Here's the payments that are being in the exact same order, because I'm just assuming that an 80% loan at the high balance conforming rate by Freddie Mac on the national average, which is going to be a higher payment than you can get if you're doing an 80% loan. You go also, a lot of people qualify for relationship pricing for using their retirement funds. Here now are the 13 counties of the 5 regions. I also add in the Bay Area just because the media talks about it. You have the now reading, which is the current reading. You have the percent change from last week and the percent change from 5 weeks ago. So you can get some idea of which direction the metric is moving. And with that, we're back to the different charts. YouTube timestamps in the description below. Appreciate any feedback, appreciate likes and subscriptions. Thanks. Bye for now.